Welcome back to Accounting 101. In this video, we'll cover Chapter 9, Plant Assets, Natural Resources, and Intangible Assets. The learning objectives for this chapter is to explain the accounting for plant asset expenditures, apply depreciation methods to plant assets, explain how to account for the disposal of plant assets, describe how to account for natural resources and intangible assets, and discuss how plant assets, natural resources, and intangible assets are reported and analyzed. So first, plant assets. These are resources that have a physical substance, are used in the operation of business, are not intended for sale to customers, and are expected to be of use to the company for a number of years. So it's a physical asset. You can put your hands on it and you're using it in your business. So these plant assets can have multiple names. Plant assets is a common one. We can also refer to it as property, plant, and equipment. Sometimes it's shortened to PPE or PP&E. Plant and equipment and fixed assets. All used interchangeably. Different companies just use different things. So if you see any of those types of language, you're all talking about the same thing. Here's a graphic showing some different companies and what their plant assets are as percentage of total assets. If you look at Wendy's at the top there, 73%. I'm going to make an assumption that they probably own a lot of their buildings and land that the restaurants are in, so that's why it's so high. If you go down to Microsoft, only 3%, so it's pretty small. A lot of what Microsoft has is software. And software isn't necessarily a tangible asset. And in intellectual property, they've got patents. Those are more would be considered intangible assets that we'll talk about later in this chapter. So it makes sense that they have a much smaller plant assets as a percentage of total assets. The cost of plant assets. We're going to use the historical cost principle. So we require that companies record plant assets at cost. Cost consists of all expenditures necessary to acquire an asset and make it ready for its intended use. Okay, that's a key phrase there, make it ready for intended use. So this is going to include a lot of things that you may not think about when you spend when you're acquiring an asset, and we'll go through some examples. Once the cost is established, it becomes the basis of accounting for the plant asset over its useful life. The useful life is an estimate of the expected productive life of the asset. It's also called service life. Okay, and we'll see how we use that in calculating depreciation in a few slides here. So we'll talk about land. Land is a plant asset. So all necessary costs incurred in making the land ready for its intended use. Increase the land account. We increase it with the debit. It's an asset account. Normal balance is debit and increases with the debit. Some typical costs in acquiring land is the cash purchase price. Pretty obvious. But then you can also include closing costs such as title and attorney fees. Any commissions paid to real estate brokers for acquiring the land. Accrued property taxes and other liens on the land assumed by the purchaser. So you can't count the property taxes, but if you take over the property taxes that were assumed, you're assuming those that the previous buyer had incurred, you can include those accrued costs. So we'll look at an example here. Hayes Company acquires real estate at a cash cost of $100,000. Property contains an old warehouse that is raised at a net cost of $6,000. So we had $7,500 in demolition costs, and we recognized $1,500 of proceeds from salvaged materials. Then we had attorney's fee of $1,000, real estate broker's commission of $8,000. What is the amount to be reported as the cost of land? So we have the purchase price. We're going to add the net removal of the warehouse because we're not using that, so we need to get the land ready for its intended use. The attorney's fee and the real estate broker's commissions all get included. So $115,000 is the cost of the land. When we make this entry into our books, we're going to debit the account land, that asset account, and credit cash. Okay. Now we're using cash because any financing we have is independent of making the purchase. Now we may go out and get a loan for this $115,000 or part of it. That is fine, but for simplicity, we're going to assume that we just pay cash for that. And if we have any financing, it's handled separately. Land improvements. This is structural additions with limited lives made to land. So it's not buildings, but it's just structural additions. So includes all expenditures necessary to make the improvements ready for their intended use. Some examples are driveways, parking lots, fences, underground sprinklers. So it's those types of things. It's not buildings themselves, but things that you do to the land. It's got a limited useful life, and you expense or depreciate the cost of the land improvements over their useful lives. And we'll get into how we do that in the next objective. Buildings, again, includes all costs related directly to the purchase or construction. If we're purchasing a building, it's the purchase price, it's the closing costs in real estate brokers' commissions. Any remodeling and replacing or repairing the roof, floors, electrical wiring, and plumbing is included. So if we take over a building and we need to remodel it to fit our needs, all that remodeling costs will be included in the cost of the building. If we build a building, the construction costs, so it's the contract price plus payments for architect fees, building permits, excavation costs, interest costs incurred during the construction period. So if we're takes a number of years, that interest that we're paying on any loans or something, we can include that. So if you think of the land over down the street here, where we have Arlington Park that the Bears bought, they probably financed that, so they're incurring interest because they haven't done anything with that yet. When they build the stadium, they can include some of those interest costs into the cost of the stadium. Equipment includes all costs incurred in acquiring the equipment and preparing it for use. Okay, so cash purchase price, sales tax, freight charges to get the equipment delivered to your plant, insurance during transit paid by the purchaser, and then expenditures required in assembling, installing, and testing the equipment. Okay, so getting it set up, maybe hiring another company to come in and make sure that it's working correctly and that type of thing. All those setup costs can be included in the cost of the purchase of equipment. So here's an example for a delivery truck. Leonard Company purchases a delivery truck on January 1st. Cash price of $22,000. Related expenditures are sales taxes, $1,320, painting and lettering, $500, motor vehicle license, $80, and a 3-year accident insurance policy, $1,600. Compute the cost of the delivery truck. So with these costs, we would include the cash price, we would include the sales tax, and the painting and lettering. Presumably that's our logo or something on the truck, so we include that. So the cost of the delivery truck is $23,820. We did not include the motor vehicle license. That's an annual cost that we incur to be able to operate the vehicle. So that's an operating expense. And then the insurance policy, we've talked about prepaid insurance before. So that's going to be over the 3 years that we're going to expense that. And that's not included in the cost of the truck. What's the journal entry to record these costs? We're going to debit equipment, the $23,820 that we calculated on the previous slide. Debit license expense, because we're going to expense that when we incur it. And then debit prepaid insurance for the insurance policy. And then we paid cash for all those, so we credit cash $25,500. So that's how we record all those costs. Here's an example for cost of factory machinery. Company purchased factory machinery at a cash price of $50,000. Related expenditures are sales taxes $3,000, insurance during shipping $500, and installation and testing $1,000. What is the cost of the factory machinery? All of these costs are included and can be put into the cost of the machinery. So we have the cash price, sales taxes, insurance during shipping, installation and testing. Total cost is $54,500. Expenditures during the useful life. So ordinary repairs are expenditures to maintain the operating efficiency and productive life of the asset. So these are normal repairs that you have to do to keep the machine running. A lot of times, you know, machinery used in manufacturing, you're going to, be 10 to 15 to 20 years of life. You're going to have to do repairs on those. You can't just take it out of the box, so to speak, and run it for that many years without doing repairs. Those ordinary repairs are going to be expensed. We do that with a debit to maintenance and repairs expense. This is referred to as revenue expenditures because we're keeping the machinery running in its state that it should be running at, and we're generating revenue against that. Any additions and improvements that are incurred to increase the operating efficiency, productive capacity, or useful life of a plant asset, that is a debit to the plant asset affected, and it's referred to as capital expenditures. So if I had a machine that could make 100,000 parts a day, and some new technology comes out and I can add it to my machine and make 120,000 pieces a day, and I do that, I'm increasing the productive capacity of that asset, so I can capitalize that, debit the plant asset, and not expense it as a repair. So it's a very kind of gray area between what's an expense and what's capital. I have daily, if not daily, weekly for sure, people coming and asking me, all right, we're going to have to spend so much for this, can we capitalize it or not? And what they're trying to decide is, does it have to go to the repairs and maintenance expense, or can it be put as a capital item and we depreciate it? So it's a decision that accountants have to make on an ongoing basis. So here's a big fraud. Bernie Ebbers, he was the founder and CEO of the phone company WorldCom. The company engaged in a series of increasingly large debt finance acquisitions of other companies. So they were growing very quickly with these acquisitions. Stock price increased dramatically. He was the king of telecom. This was after the telecom industry kind of got deregulated, so there was competition. When he was acquiring these different companies, they had different accounting systems. The financial records of WorldCom were a mess. When the performance started to flatten out, Bernie coerced WorldCom's accountants to engage in a number of fraudulent activities to make net income look better than it really was, and thus prop up the stock price. One of these frauds involved treating $7 billion of line costs as capital expenditures. The line costs, which were rental fees paid to other phone companies to use their phone lines, had always been properly expensed in previous years. But since they capitalized that $7 billion, they were able to delay the expenses that were recognized in the financial periods for future years, and they boosted current period profits. So $7 billion. What were the missing controls? We had documentation procedures. The accounting system was a disorganized collection of non-integrated systems, which resulted from the acquisitions. Top management took advantage of this disorganization to conceal its fraudulent activities. And then independent internal verification was missing. Should have been detected by routine comparison of the actual physical assets with the list of physical assets shown in the accounting records. So we consider that doing a physical asset inventory. So we talked about doing inventories on or physical counts on inventory. You can also do a physical count on fixed assets to make sure all that the assets you have in your accounting records are actually there and are being used like they're supposed to be. So that would have caught this. Leases. So many U.S. firms use leases. Leasing is a big business for U.S. companies. In a recent year, leasing accounted for about 33% of all business investment, so $264 billion. Who does the most leasing? It's major banks such as Bank of America, Wells Fargo, U.S. Bank, or U.S. Bank Equipment Finance are the major lessors, so they're loaning the money. Companies also have separate leasing companies, Boeing Capital Corporation, Dell Financial Services, John Deere Capital Corporation. So these are all subsidiaries of those companies. As an excellent example of the magnitude of leasing, leased planes account for nearly 40% of the U.S. fleet of commercial airlines. There's a company called Lease Finance Corporation in Los Angeles that owns more planes than any airline in the world. So that's kind of a little mind-boggling that they go out and they buy the planes from Airbus or from Boeing, maybe some private planes as well, and then they lease them to the people that are actually using those planes, and they're making their income through the lease payments. It's becoming more common in the hotel industry. So the big hotel companies are choosing to lease hotels that are owned by someone else, so they're not having to tie up cash in building or purchasing hotels. Let someone else pay that cash up front, and then they just pay a rental fee, a lease fee to use those properties. So why might airline managers choose to lease rather than purchase their planes? They include favorable tax treatment, better financing options, increased flexibility, reduced risk of obsolescence, and often less debt shown on the balance sheet. Okay, so they're not borrowing the money, but they're doing leasing. Recently, probably 5 years ago now, in 2020, 2021, somewhere in there, some of the accounting rules around leases changed, and now companies have to actually show the liability for their lease payments on their financial statements. So that benefit is kind of going away, but some of these other ones are still benefits, so they're still going to continue to do that. So let's go through this example. Assume that Drummond Corporation purchases a delivery truck for $15,000 cash. They had sales tax of $900, delivery cost of $500. They pay $200 for painting and lettering, a $600 for annual insurance policy, and $80 for motor vehicle license. Explain how the company should account for each of these costs. So the first four costs, the first four payments, the purchase price, the sales tax, the delivery fee, the painting and lettering, all expenditures necessary to make the truck ready for its intended use. Therefore, the cost of the truck is $16,600. The other two costs, the annual insurance and the license, are operating expenses incurred annually during the useful life of the asset, so those are expensed as operating expenses. So that's getting the cost for an asset and how we recognize it. Now we'll look at how we apply depreciation methods to plant assets. Depreciation is the process of allocating to expense the cost of a plant asset over its useful or service life in a rational and systematic manner. So what does that mean? It means we're going to take the cost and allocate it to expense. So we're going to expense the cost of the asset over the useful life of that asset. We're going to estimate what that useful life is. And in a rational and systematic manner just simply means we're going to have some methodology that we follow, and we continue to follow that over the useful life. We're not just arbitrarily deciding what costs to do and what periods. And we'll go over some examples and different methodologies that we can do that on. This is a process of a cost allocation, not asset valuation. So we're not attempting to put the value of that asset on our books. It's just a way of taking the cost over the life It applies to land improvements, buildings, and equipment, but not land. So land does not get depreciated. All the other plant assets that we talked about do get depreciated. It's depreciable because the revenue producing ability of an asset will decline over the asset's useful life. So as you use an asset, whether it's a building, piece of equipment, delivery truck, whatever it is, the value or the revenue producing ability is going to decline. So we're taking that cost and spreading it over the useful life. So what do we consider when we compute our depreciation? Well, first we're going to take the cost. So we went through that. It's all expenditures necessary to acquire the asset and make it ready for its intended use. We're going to look at the useful life. So that's the estimate of the expected life of that asset. And we're going to look at the salvage value. So that's the estimate of the asset's value at the end of its useful life. So what do we think it'll be worth at the end of its useful life? Depreciation expense is reported on the income statement. Accumulated depreciation, remember, is reported on the balance sheet. It's a deduction from plan assets. It's a contra asset account. Different depreciation methods. Management selects the method that it believes best measures an asset's contribution to revenue over its useful life. So three common ones and three that we're going to talk about in this course is straight line, units of activity, and declining balance. As you can see from this chart over here, straight line is by far the most common. 83% of companies use straight line. Units of activity is 5%, declining balance is 4%, and then all the others combined is 8%. So straight line is the most common and it's the easiest to calculate. So we're going to use this information for a few examples. So Bill's Pizza purchased a small delivery truck on January 1st, 2027. The cost was $13,000. The estimated salvage value is $1,000. Estimated useful life in years is 5, so we expect to use it for 5 years. And the estimated useful life in miles is 100,000. So we expect that we can drive that delivery vehicle for 100,000 miles. Using the straight line method, the expense is the same for each year. The depreciable cost equals the cost less the salvage value. So if we take the cost of $13,000 minus the salvage value of $1,000, our depreciable cost is $12,000. So using straight line, what we do is we take that depreciable cost and divide it by the useful life in years. So in this case, 5. So we take the $12,000 depreciable cost divided by 5 years, and our depreciation expense is $2,400. And it'll be that same $2,400 for 5 years, for the full 5 years of the asset. Here's a chart that kind of shows that. So we've got the years coming down here. The depreciable cost is $12,000. It's going to remain $12,000 for the life of the asset. The depreciation rate is 20%, which is 1 divided by 5. That's how we got the 20%. It's just 1 out of the useful life in years. 2,400 is the annual depreciation. If we do it for 5 years, we're going to get 12,000, which is the depreciable cost. Okay, and then accumulated depreciation is shown. Our book value is going to be our cost, 13,000, not our depreciable cost, our cost that we have on the assets, the 13,000, less the accumulated depreciation. So at the end of the first year, we have 2,400 of accumulated depreciation. Our book value is the 13,000 minus 240. 2,400, sorry. So 10,600 is the book value. Okay, and as you see, as we go on and continue to have more depreciation, our book value is going to be declining until we get down to the salvage value. The entry we make to record depreciation is going to be debit depreciation expense, 2,400, credit accumulated depreciation, 2,400. Okay, so this says it's the 2027 journal entry. Using the straight line, it's going to be the same entry for each of the 5 years, or however many years the useful life is. Let's go through another example. Iron Mountain Ski Corporation purchased new snow grooming machine for $50,000. Machine is estimated to have 10-year life with a $2,000 salvage value. What journal entry would Iron Mountain Ski Corporation make at December 31st, 2027 if it uses the straight line method of depreciation and adjusts its accounts annually? Okay, so we bought it on January 1st. A year later, on December 31st, we're going to make the entry to record depreciation expense. Now it's key that they say they adjust it annually, so you got to be careful of that. In different problems, it may say they do it monthly or quarterly or something, so you need to be aware of that for the entry you're going to make. So using straight line, we're going to take the cost minus the salvage value divided by the useful life. So $50,000 cost minus $2,000 salvage value divided by 10. So 4,800 is the annual depreciation. And we're going to debit depreciation expense, credit accumulated depreciation equipment for that 4,800. Okay. Now let's look at units of activity method. So companies estimate total units of activity. So machine hours for machinery, miles for delivery truck. So something that that it makes sense for the piece of the asset that you're going to depreciate it. And we're going to use that to calculate the depreciation cost per unit. Then we're going to apply that cost per unit to the number of units in a given period. So the expense is going to vary based on the units of activity. This is suitable for factory machinery, delivery trucks, that type of thing, but it's not suitable for buildings or furniture. And depreciable cost is cost less salvage value. So the same that we saw in straight line. So if we use that same delivery truck example, our depreciable cost is $12,000. Remember, that was $13,000 cost less $1,000 salvage value. We had 100,000 miles estimated units of activity. So if we divide the 12,000 by the 100,000, we get 12 cents per unit. In this case, it's miles. So every mile we drive is a depreciation expense of 12 cents. We drive 15,000 miles in the first year. Our depreciation expense is going to be the 12 cents times the 15,000 miles, or 1,800. Okay, and here's an example. You would not be able to do this at the beginning of the asset's life because you don't know the units of activity. You can estimate it to kind of guess what it could be, but straight line, you know it's going to be the same every year. Units of activity, you have to wait till you complete the activities to see how many units there are. But this is an example saying, here's the years, here's the activity in those years. It adds up to 100,000. It's miles. It shouldn't have the dollar sign there, so I apologize for that. The annual depreciation expense is the 12 cents per unit, 12 cents per mile, times the miles in each year to calculate the depreciation expense that year. Total depreciation expense is going to be $12,000, which is the depreciable cost. And again, accumulated depreciation increases and the book value decreases over the life of the asset. And we do it until accumulated depreciation equals the depreciable cost of $12,000 and the book value equals the salvage value of $1,000. The entry we would make in 2027 to record depreciation is debit depreciation expense, credit accumulated depreciation. So it's the same accounts, just the amounts are different. This is based on the units of activity versus the straight line. So now if we go back to Iron Mountain Ski Corporation, they bought that new machine on January 1st for $50,000 with $2,000 salvage value. This machine is used for 12,000 hours during 2027. We're saying the estimated life is 100,000 hours. So what would be the journal entry to record the first year of depreciation in this case? Well, first we have to figure out what the rate is, the depreciation cost per unit. So in this case, it's hours of use. Depreciation cost per unit is the cost minus the salvage value, depreciable cost, divided by the useful life, 100,000 hours. So the 50,000 minus 2,000 divided by 100,000 is 48 cents per hour. So the depreciation expense is the depreciable cost per unit, so 48 cents, times the activity during the year, in this case hours, so 48 cents times the 12,000 hours that we ran the machine in 2027, $5,760 is the depreciation expense, and the entry is debit depreciation expense, credit accumulated depreciation for that 5,760. And the third method we're going to talk about is the declining balance method. This is an accelerated method. So we have decreasing annual depreciation expense over the asset's useful life. Commonly is the twice the straight line rate. So we call it the double declining balance sometimes. So that's, it's double the straight line rate. The rate is applied to the book value, which is different because we're ignoring the salvage value in determining the amount of the, to calculate the rate and to calculate the depreciation expense each year. So if we think about the 5-year life, we said it was a 20% rate. If we double that, it's 40% rate. So our declining balance rate will be 40%. But we don't apply that to the depreciable cost like we did in straight line. We're going to apply it to the book value at the beginning of the year. So year one, the book value is the cost, 13,000. Depreciation expense is 5,200. So if we look at all 5 years under this example, first year we just went through, the book value is the cost, 13,000, 40% rate, 5,200 is the annual depreciation expense in 2027. That makes our accumulated depreciation 5,200 and our book value 7,800. Again, the book value is the cost less accumulated depreciation. Now in year two, we're going to take the 40%, but we don't multiply it by the cost again, we multiply it by the book value. So we have to calculate year one to get the book value, then we use that book value times the same rate of 40%, and we have 3,120. Now our accumulated depreciation is the 5,200 from year one plus the 3,120 from year two, 8,320, and our book value is 4,680. We use that book value for year three, 2029, times the same rate to get the depreciation expense for that year, which increases accumulated depreciation and decreases the book value. And we continue through the life of the asset until we get down to accumulated depreciation equals 12,000 and the salvage value is 1,000. Now we didn't use salvage value to calculate depreciation to begin with, but we do take that into account when we end our depreciation. And this note says down here that if we did the calculation, 1685 times 40%, we would come up with $674 of depreciation. But that wouldn't get us to exactly 12,000 of accumulated depreciation and 1,000 of book value. So we adjust that in the final year to make the numbers what it needs to be. So we're into the useful life 5 years. We adjust that last year depreciation expense so that our accumulated depreciation equals depreciable cost and our book value equals our salvage value. You can see if you look at depreciation expense per year, Straight line was the same each year. Units of activity depended on the activity that year, so it varies. Under the declining balance, it's large in the first year, and each year it declines. So as the book value declines, our expense is going to decline as well. The entry we make for 2027 is the same as we've seen before: debit depreciation expense, credit accumulated depreciation. The only difference is the amount. So in this case, $5,200. Now we'll go back to the Iron Mountain example. So we had a 10-year life, $50,000 machine, $2,000 salvage value. If we use the declining balance method, in this case they're specifically stating the double declining balance method, what is the entry we make on December 31st, 2027? So the depreciation rate, again, is 2 times the straight line rate. If it's a 10-year life, it's a 10% straight line rate, because we're going to take 10% of the depreciable cost over the each year. So we take 2 times 10%, so their rate for double declining is 20%. We're going to apply that rate to the book value. The book value is cost less accumulated depreciation. Since our first year, we have no accumulated depreciation, so our book value is the $50,000 cost. The expense is depreciation rate times the book value, so 20% times $50,000. $10,000 is our depreciation. And the entry, again, debit depreciation expense, credit accumulated depreciation. Now we'll look at the 3 methods and compare them. So first thing I want to point out is that in all 3 cases, our total depreciation is going to be $12,000. That's our depreciable cost. So each method gets us to our depreciable cost, which means our book value is going to be the salvage value of $1,000. Straight line, we have the same amount each year. Units of activity is going to vary. So it's 1,800, then 36, then lower, then higher. So it's going to vary based on the activity that we do in that year. And then declining balance, it's going to start up higher, but then the expense for the last year is going to be much lower because it declines as we go through. And here's graphically the annual depreciation expense each year. So straight line, straight across. Units of activity is up and down, and declining balance decreases in a nice curve here. But in all 3 cases, we're still going to depreciate the same amount, and our book value at the end of the useful life is going to be the same amount. So here's another example. Mendez Corporation purchased a truck at the beginning of 2027 for $100,000. The truck is estimated to have a salvage value of $12,000, useful life of 160,000 miles or 8 years. It was driven 23,000 miles in 2027 and 31,000 miles in 2028. Compute the depreciation expense for 2028 using each of these methods. Okay, so you need to be aware that's asking for the 2028 depreciation, so the second year of depreciation. So we're going to not have to necessarily show the expense for 2027, except for the declining balance, because we need to know the book value. So straight line, it's the cost minus the salvage value divided by useful life. The cost is 100,000. The salvage value is 12,000. So 88,000 divided by useful life of 8 years gets us $11,000. Since this is the straight line, it's the same for each year. So it's going to be 11,000 for 2027 and 2028. So that's what it is for 2028. If we look at the units of activity method, cost minus salvage value divided by useful life again, the 100,000 minus 12,000, it's 88,000. In this case, the useful life is in terms of activity or miles. So the 88,000 divided by 160,000 miles is 55 cents a mile. In year 2, it said we drove 31,000 miles in 2028. That's what we're trying to calculate the depreciation expense for. So we take that 31,000 times 55 cents a mile, and it's $17,050 is our depreciation expense for 2028. Okay, now we'll look at the double declining balance method. So with that, we take twice the straight line rate to get our rate that we're going to apply to the book value. So the depreciation rate is 2 times the straight line rate. In this case, the straight line rate is 12.5%. So we multiply that by 2 to get 25%. How did we come up with the 12.5%? Well, the example they show here is 100% divided by the useful life in years, so 8 years. So 100% divided by 8 is a 12.5%. Simply 1 divided by the useful life in years, so 1/8, 1 divided by 8 will give you 0.125, which is the same thing. So we're going to take 25% times the book value. So for 2028, that is going to be 25% times $75,000 equals $18,750 is our 2028 depreciation expense. How did we get the $75,000? This is the only case where we have to worry about what our 2027 depreciation was, because we're using the book value. We have to calculate depreciation until the year that we're calculating it for. In this case, it's just 1 year, but we take $100,000 cost with the book value of beginning of 2027 times the rate of 25% is $25,000. So our book value is the 100,000 minus 25,000, or the 75,000 at the beginning of 2028. Okay. They were asking for the 3rd year depreciation. We'd have to do the first 2 years to get the book value and then apply the rate. So just be careful of what year they're asking for on the double declining method. Depreciation and income taxes. The IRS does not require taxpayers to use the same depreciation method on a tax return that it uses in preparing financial statements. Okay. Taxpayers must use the straight line method or a special accelerated depreciation called the Modified Accelerated Cost Recovery System, or MACRS. Okay. We won't get into details of how you calculate that or what that means, but just know that there's 2 methods. Use the straight line or use the accelerated method. And this changes quite often. So the bill that was passed in 2025 allowed companies to take 100% depreciation in year 1. So anything that is put into service in 2025, you can take 100% of that cost as depreciation expense on your tax return, and lower your tax expense for that 1 year. Okay, so I can't remember how that was expiring. They put it back in with this new bill, and it's good for a few years at least. So it could change again, depending on what Congress does with some of their spending bills. Here's an example of disclosure notice in the notes. So Southwest Airlines talks about depreciation using the straight line method to estimate a residual value of periods ranging from 23 to 25 years for flight equipment. Okay, so using straight line, and the number of years of useful life is somewhere between 23 and 25 years is what they're saying. Revising period act depreciation. So if we make a change in our depreciation, we account for the change in the period that we make the change in any future periods. This is considered a change in estimate. We don't go back and change the depreciation reported for prior years. It's not considered an error. So these are all estimates that we're using for salvage value and useful life. If something changes along the way and makes us, change those estimates, we can change our depreciation on a go-forward basis. So it's the year we make the change and then anything forward. So we're going to use a step-by-step approach to do this. We determine the new depreciable cost and then divide the new depreciable cost divided by the remaining useful life. So we'll look at an example here. So Bill's Pizza and that delivery truck that we've been looking at in January 2030, they decided to extend the useful life of the truck by 1 year, so a total of 6 years. We're going to increase its salvage value to $2,200. Okay, the company has used straight line method to depreciate the asset to date. So remember that was $2,400 per year. Accumulated depreciation after 3 years, so 2027, 2028, and 2029, is $7,200, which is the $2,400 times 3. So the book value is $5,800. The new annual depreciation is we're going to take the book value less the revised salvage value, so $2,200 in this case. So we have a depreciable cost of $3,600. We're going to have 3 years remaining, so the original 2 plus the new one that we're adding on. So 3 years, $36,000 depreciable cost. Our new annual depreciation is going to be $1,200. So by increasing the salvage value $1,200 and adding 1 year to the useful life, we cut our depreciation expense in half. Okay, so it just happened in this case with these numbers that happen. It's not a stated fact, but if you extend the useful life and you increase the salvage value, you're going to reduce your depreciation expense. So Chambers Corporation purchased a piece of equipment for $36,000. Estimated 6-year life, $6,000 salvage value. So the straight line depreciation was $5,000 per year. That's the cost minus the salvage value divided by useful life. At the end of year 3, before the depreciation adjustment, it estimated the new total life to be 10 years and new salvage value to be $2,000. So we're extending the useful life by 4 years, but we're reducing the salvage value. What is the revised depreciation? So accumulated depreciation after 2 years was 2 times the $5,000 or $10,000. The book value then is $26,000. So we take the book value of $26,000 less the new salvage value of $2,000. So we have $24,000 depreciable cost. And we're going to take that over 8 years remaining. So 10 years total. We had used 2 years up already at depreciation. So we take that 24,000 divided by 8, and our new depreciation expense is going to be $3,000 a year. So this is, again, changing the useful life and the salvage value, and we reduced our depreciation. Next, we're going to learn about how to account for the disposal of plant assets. So there's 3 ways we can dispose of a plant asset. We can sell it, we can retire it, or we can exchange it. Okay, we're not going to talk about the exchange. If you're really interested, it's in the appendix of the book, and you can read and learn about it, the exchanges, but we don't need to know it in this class. So in a sale, what it says, we're selling the equipment to somebody else. Retirement is just we're getting rid of the asset, so scrapping it or basically throwing it away, donating it somewhere potentially. So we're not selling it, we're just getting rid of it. We're going to record the depreciation up to the date of disposal. Okay, so when you look at some of these problems that you're going to have in homework, it's going to tell you maybe mid-year when you get rid of it. So you have to worry about how much was depreciated in a partial year. So be careful about that. Then we eliminate the book value by debiting the accumulated depreciation and crediting the asset account. So that's considered writing the asset off our books. So we have a cost with the debit in the asset account. We have accumulated depreciation as a credit in this contra asset account. So we are going to do the opposite, debit the accumulated depreciation to reduce it and credit the asset account to reduce that. So if we have a sale of plant assets, we're going to compare the book value of the asset with the proceeds received from the sale, so the amount that we sold it for. If what we receive, the proceeds, exceed the book value, we have a gain. If the proceeds are less than the book value, we have a loss. So let's go through an example. On July 1st, 2027, Wright Company sells its used office furniture for $16,000 cash. The office furniture originally cost $60,000. As of January 1st, 2027, it had accumulated depreciation of $41,000. Depreciation for the first 6 months of 2027 is $8,000. Prepare the journal entry to record depreciation expense up to the date of the sale. Okay, so in this example, they did the hard work for us. They gave us what that depreciation was. You may see a problem in your homework where you have to calculate what the annual depreciation was and then take half of it because it's at the end of June. So just be aware of that. But in this case, $8,000 is the depreciation for the first 6 months. We're going to debit depreciation expense, credit accumulated depreciation. Okay. Now we have cost of the office furniture was $60,000. Our accumulated depreciation now, after we book the $8,000 for the first half of the year, is $49,000. So it's 41 that we started with, and then the 8,000 for the year, or the partial year. Then so the book value is 11,000. We sold it for 16,000. So we're going to have a gain on disposal of plant asset of $5,000. And we record the entry as follows. We're going to debit cash the 16,000. That's what we received. We're going to debit our accumulated depreciation for what that balance is on this piece of equipment, $49,000. Credit equipment account for the cost, $60,000. And we have a gain, so we credit the gain on disposal of plant assets of $50,000. Okay. Now, if we would have sold it for $9,000 instead of $16,000, that's going to be less than our book value. So we have a loss of $2,000. And that entry is as follows. Still debit cash, but it's for $9,000. Our debit to accumulated depreciation is going to be the same, the $49,000. Our credit to equipment is the same, $60,000. But since we have a loss, now we're going to debit the account loss on disposal of plant assets for $2,000. Okay. Retirement of plant assets. This is a disposal where no cash is received. We're going to decrease with the credit the asset account for the original cost and decrease, debit, the accumulated depreciation for the full amount of depreciation taken over the life of the asset. So that's the same that we saw when we recorded the sale. The loss is equal to the asset book value on the date of retirement. You cannot have a gain on retirement because you have no proceeds. So you assume that if you think about a sale, what we went through, the proceeds are zero. So if you have a book value, if the book value is not zero, you're going to have a loss every time you retire a plant asset. So let's look at an example here. Hobart Company retires its computer printers, which cost $32,000. The accumulated depreciation on these printers is $32,000. So they fully depreciated, $0 book value. Prepare the entry to record this retirement. So what happens if a fully depreciated plant asset is still useful to the company? The asset and its accumulated depreciation continue to be reported on the balance sheet without further depreciation adjustment until the company retires the asset. So we keep the cost, we keep the accumulated depreciation. It's a $0 book value, but it just sits there until we retire it. So in this case, for the Hobart example, we debit accumulated depreciation, $32,000, and credit equipment, $32,000. Now we'll look at a retirement with a loss. Sunset Company discards delivery equipment that cost $18,000 and has accumulated depreciation of $14,000. What does that entry look like? We're going to debit accumulated depreciation for the $14,000, credit equipment $18,000, and debit the loss on disposal of plant assets for $4,000. Companies report a loss on disposal in the other expenses and losses section of the income statement. If it's a sale and we have a gain, it goes in the other gains and revenue section. Overland Trucking has an old truck that cost $30,000. Has accumulated depreciation of $16,000. They decided to sell the truck. What entry would Overland make to record the sale of the truck for $17,000 cash? We're going to debit cash $17,000, credit accumulated depreciation for $16,000, credit equipment for $30,000, and then credit the gain on disposal of plant assets for $3,000. We calculated that $3,000 by taking $17,000 proceeds less the book value, which is cost less accumulated depreciation. The truck is worthless in this example, so the same truck. What entry would Overland Truck make to record the retirement? We're going to debit accumulated depreciation for $16,000 like we did in the other example. Credit equipment $30,000. Now we have a loss of $14,000, which is the book value. Now we'll talk about natural resources and intangible assets. Natural resources consist of standing timber, underground deposits of oil, gas, and minerals. Okay, it's got some distinguishing characteristics. It's physically extracted in operations. It's replaceable only by an act of nature. The cost of the natural resources is the price needed to acquire the resource and prepare it for its intended use. Now we're going to talk about depletion. So accountants love to have different names for similar concepts. So depletion is the allocation of the cost of natural resources to expense in a rational and systematic manner over the resource's useful life. Sounds a lot like the definition of depreciation. Okay, and it is. It's basically taking the same idea. Now you're just doing it, and they call it depletion. Usually, companies use the units of activity method. And depletion generally is a function of the units extracted during the year. So here's an example of a coal company. They invest $5 million in a mine estimated to have 1 million tons of coal and no salvage value. So to get the depletion cost per unit, it's the same type of calculation we did for the depreciation cost per unit, where we take the total cost minus the salvage value divided by the total estimated units available. So in this example, $5 million cost, no salvage value, divided by 1 million tons. So we get $5 per ton. So every ton of coal we extract, it's going to be $5 of depletion. So we have our depletion cost per ton. In the first year, Lane extracts 250,000 tons of coal. So we're going to get $1,250,000 of annual depletion. It's that $5 times the number of tons, 250,000. And our journal entry is going to debit inventory, 1,250,000, and credit accumulated depletion, $1,250,000. So this is different than depreciation because we're not booking an expense. So we're going to spread the cost like we do in depreciation, but we end up with inventory when we actually extract it. So we're in the business of selling coal. So coal is our inventory. In order to get that inventory, we have to extract it out of the ground. We had a cost of the mine, and we're going to deplete that cost over the life, which is the number of tons of coal we're going to extract. Okay, so similar concept, similar calculations, just treated differently on the entry in that we debit inventory instead of debiting the expense. Intangible assets. These are rights, privileges, competitive advantages that result from ownership of long-lived assets that do not possess physical substance. So they're intangible. You can't touch them. Okay. It's a limited life or an indefinite life. And some common intangibles are patents, copyrights, goodwill, trademarks and trade names, and franchises. We'll talk about what some of these mean as we go through. So limited life intangibles, we're going to amortize to expense the cost of that intangible. We're going to amortize. It's going to be, again, very similar to depreciation. We're allocating the cost to expense, and we're going to credit the asset account. In an indefinite life intangibles, there's no foreseeable limit on the time the asset expected to provide cash flows, so therefore there's no amortization. So you have to make the decision, is it a limited life or an indefinite life? And then the helpful hint over here, amortization is to intangibles, what depreciation is to plant assets, and depletion to natural resources. So again, same type of concept. We're allocating the cost over a useful life, over a time period. We call it different things. Amortization for intangibles, depreciation for plant assets, depletion for natural resources. So patents. This is an exclusive right to manufacture, sell, or otherwise control an invention for a period of 20 years from the date of the grant. We capitalize costs of purchasing a patent and amortize it over its 20-year life or its useful life, whichever is shorter. We expense any research and development costs in developing a patent. Legal fees incurred successfully defending a patent are capitalized to the patent account. So if someone is granted a patent and they decide to sell the patent, whoever buys that can capitalize the cost of buying that patent into the patent account, and then they have 20 years from the date of the grant. So depending on how old that is, or however long they think it is, if it's shorter than that, then they can amortize it. If I'm the company that developed the patent, my cost in developing that patent is considered research and development. I do not capitalize that. I expense research and development costs. But if I successfully have to defend that patent, I can then take those costs of defending it and make it into a patent as an asset and then amortize that. Copyrights. This gives the owner of the exclusive right to reproduce and sell an artistic or published work. It extends for the life of the creator plus 70 years. The cost of copyright is the cost of acquiring and successfully defending it, similar to patents, and amortized to expense over the useful life. The useful life generally is shorter than the legal life. Trademarks and trade names. These are a word, phrase, jingle, or symbol that identifies a particular enterprise or product. Some examples: PlayStation, YouTube, Big Mac, TikTok, Coca-Cola, Jeep. Okay, those are all kind of common uh, names of things that you've heard, but you kind of know what that is when you hear it. So those are trademarks or trade names. There's legal protection for an indefinite number of 20-year renewal periods. So at the end of the 20 years, you can apply for a renewal. If it's granted, you get another 20 years where you have legal protection. Capitalized acquisition costs. Costs related to develop or maintain trademark or trade names are expensed, and there's no amortization on trademarks and trade names. So Big Mac is up there. McDonald's probably doesn't have much costs in their trademark or trade names for that because they developed it. It's probably just anytime they had to defend it. So if someone made a similar sandwich and tried to call it similar to a Big Mac, they could have to defend the right of that trademark. Glass. Google trademarked the term Google Glass. Then they tried to trademark the term glass. Why did they do this? Because the simple word glass has marketing advantages over the term Google Glass. It's easy to remember, more universal. Regulators, however, wouldn't allow this. They said the possible trademark is too similar to other existing pending software trademarks that contain the word glass. Also, the term glass is merely descriptive and therefore lack trademark protection. Regulators noted that a company that makes salsa could not trademark the term spicy salsa. The Border Stylo LLC developed a web browser extension called Write on Glass, filed a notice of opposition to Google's request. In the end, the case will probably never be resolved because Google Glass is a company product appears to have failed. So they won't need to defend it. If they were registered the term glass, where would the trademark be reported in its financial statements? On the balance sheet under the classification intangible assets. Since it's a trademark, it's got an indefinite life, we don't amortize it. Franchises. This is a contractual arrangement between a franchisor and a franchisee. Shell, Subway, Marriott are examples of franchises. It's the right to sell certain products, perform certain services, or use certain trademarks or trade names, usually within a designated geographic area. The franchise or license with a limited life should be amortized to expense over its useful life. If the life is indefinite, the cost is not amortized. And then finally, goodwill. This excludes exceptional management, desirable locate, or includes, sorry, not excludes, includes exceptional management, desirable location, good customer relations, skilled employees, high quality products, etc. So it's only recorded when a business is purchased. If you look to the right here, the fair value of a company could be here. The purchase price could be more than that fair value. So the difference is goodwill. So goodwill is recorded as the excess of cost over the fair value of net assets that were acquired. It's not amortized, but periodically you have to do an analysis to determine if the value has been permanently impaired. So if some of your projections on revenue don't come true, or you lose some customers because you thought you were buying some customers and that customer relationships. If you lose those, you might have to write down your goodwill. So there's a number of things that you have to do. It's a kind of complicated analysis that you have to go through. I've had to do it multiple times. We're not going to cover it in this course, but just know that if you see goodwill on a financial statement, they're doing an analysis periodically to determine that it still has value. Research and development costs. We talked about this briefly, but it's expenditures that may lead to patents, copyrights, new processes, new products. All research and development costs are usually expensed when incurred. So they're not intangible assets, but because they may lead to an intangible asset, patents and copyrights, we discuss them in this section. So let's look at some classification. So identify the term most directly associated with each statement. Okay. Allocation of cost of a natural resource to expense in a rational and systematic manner. So which of those terms is that definition? It's depletion. The rights, privileges, and competitive advantages that result from the ownership of long-lived assets that do not possess physical substance. It's a mouthful, but it refers to intangible assets. An exclusive right granted by the federal government to reproduce and sell an artistic or published work. Those are copyrights. A right to sell certain products or services or to use certain trademarks or trade names within a designated geographic area. That is copyright or franchise. And then cost incurred by a company that often leads to patents or new products. These costs must be expensed as incurred, and that's research and development cost or R&D costs. Now we'll look at presentation. So usually companies combine plant assets and natural resources under property, plant, and equipment in the balance sheet. Okay, intangible assets are shown separately. So if you remember back a few chapters when we talked about the classified income statement, current assets, then we had long-term investments, we had property, plant, and equipment, and we had intangible assets. So those were the categories. Here's an example where we have current assets, property, plant, and equipment, which includes plant assets and also natural resource, a gold mine in this case. And then we have some intangible assets. Analysis of asset turnover. Asset turnover analyzes the productivity of a company's assets. It tells us how many dollars of net sales a company generates for each dollar invested in assets. This ratio is computed by dividing net sales by average total assets for the period. We'll look at an example. Procter & Gamble's net sales were $76,279 million. Ending assets were $129,495 million, and beginning assets were $144,266 million. Okay, so we've seen this before where we take a simple average of the assets and we're going to take net sales divided by that average. In this case, we get 0.56 times is the asset turnover. So what that means is that each dollar invested in their assets produces 56 cents in sales. If a company is using its assets efficiently, each dollar of assets will create a high amount of sales. So 56 cents by itself, you can't really tell anything about that. If you looked at a trend or looked at a company that was comparable to this company, you could then make some analysis on it. So Paramore Company reported net income of $180,000, net sales of $420,000, total assets at the beginning of the year $460,000 and $540,000 at the end of the year. Calculate the asset turnover for 2027. Take the net sales, $420,000, divided by the average total assets. We have 0.84 times. So for each dollar of asset, we generate 84 cents of sales. That's it for Chapter 8. Please reach out if you have any questions. Thank you.